thank you everyone for joining today. My name is Rushi Shah, and I'm VP of Product here at YCharts, and we are very lucky today to be joined by Lyn Alden, who's with us. So Lyn, why don't you introduce yourself?
Sure. So welcome, everyone. Happy to be here. My background is a blend of engineering and finance. I initially went into electrical engineering, but I've had a lifelong passion for investing. And so after more than a decade of working in that field, I transitioned out of it. And in 2016, I founded Lyn Alden Investment Strategy, which provides macroeconomic and other types of investment research for both institutional and retail investors. So my goal is basically to try to make kind of like institutional type of research, but in plain English. So we talk about things like liquidity, fund flows, macro, all sorts of kind of macroeconomic things, but also specific investment ideas or sectors that are interesting.
Awesome. Thanks, Lyn. And we are going to be covering some of those topics today that you just kind of talked about. And just before we jump into things, I do want to mention a few housekeeping items. First off, on your screen, you should be seeing a Q&A section. So feel free to drop some questions in there throughout the presentation. If they make sense as we're talking, we'll try and cover them throughout the call. But if not, maybe we could take a few at the end of the call as well. Also, if you're on the call or if you registered for the call, we will be sending you a recording of the webinar afterwards. So if you wanted to rewatch a section, you definitely can do that. Feel free to subscribe or like our YouTube channel as well. And this webinar will be accessible there on our YouTube channel. And we also have other great webinars there as well. So be sure to do that. And lastly, please keep in mind that the content of this webinar is just meant for educational purposes and not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. And with that, let's jump right into the agenda. So like I mentioned today, we're joined by Lyn, and Lyn has a great website. I believe it's lynalden.com. Is that correct, Lyn?
That's correct, yes.
Yeah, so feel free to subscribe there. There's a lot of great pieces there, a lot of great information, and we're going to cover one of those in detail today, which is awesome, and that's on contrarian investing. So we'll start off with a section on following the crowd, and then really get in deep on contrarian investing in general and what we can look for in 2023. So for this first section, let's talk about following the crowd and how this whole concept of contrarian investing has come up. So Lyn, let's set the stage with a visual you had. Basically just mentioning the fact that the average investor underperforms a standard 60-40 portfolio. So what we're looking at here is a visual with a lot of different asset classes, and a few things that you point out is the reason for this is people consistently take money out of funds that have maybe recently underperformed, or they move away from underperforming sectors to ones that have gone up in price. So almost that FOMO effect. And I love showing this asset class quilt chart that we have on YCharts in our economic summary deck, because it really kind of hones in on this point of every quarter is different, everything that's going on in the economy, and it kind of leads to different asset classes overperforming or underperforming. So Lyn, I guess on that whole thought, how do you kind of read this chart, or how do you look into this whole concept?
Yeah, so looking at this chart, the one before it, basically there's a basic problem that a lot of investors face with investing, which is that if they were just to set up a relatively diversified portfolio and leave it, they'd probably do pretty well over the very long term. But there's a lot of urge that people have to tweak it, right? They want to chase what has recently done well. If say a certain stock market just keeps going up and they're not, overweight into it, for example, they feel like, well, why do I own these other things? They're not going anywhere in like 3 years or 5 years or whatever the time frame may be. And so by the end of that period, towards the later stages, they often overweight that thing that already did quite well and is now a very crowded trade, more highly valued. A lot of global capital is already kind of stuffed into it. And then that sets the stage for actually a period of underperformance, most likely, not every time, but most likely, statistically speaking, over the next 3, 5, 10 years, whatever the time frame may be. And so by chasing periods of past returns and getting out of things that are cheap and going into things that are expensive, they kind of systematically underperform a relatively passive diversified benchmark, which is, that's pretty catastrophic over 40-year let's call it investing career, right? That can lead to considerably less retirement savings by the time you're done. And then going back to the slide we had after that, basically that on a quarter by quarter basis, and also if we had this similar type of quilt up for like a 1 year return, for example, it would look very similar, which is that any given year you can have very different assets that are doing well or doing poorly, and then those tend to do quite, the ones that did well in a given period tend to do very poorly after that. They're often filled with euphoria. They're overvalued relative to their fundamentals, and so they tend to fall off in the quarters and years ahead. And so by chasing those past returns, investors more often than not hurt themselves. And so basically, the kind of the two ways to counter that are either to stick with a very rules-based, diversified, just firm approach, or to lean in the opposite way, to basically lean into things that are maybe haven't done well for a 3 to 5 year period, but that that are showing signs that kind of transition, some of either the macro factors or the valuations or the fund flows may be gradually turning, and that there's maybe an opportunity to outperform by kind of going against the crowd.
Yeah, definitely. And there's been a lot of people in history that have mentioned things like this, or kind of talking through this whole concept. I know I've heard this Warren Buffett quote a bunch in college classes, or just in general when people are talking about investing. Are there any here, Lyn, that you wanted to highlight, or any quotes from other folks out there?
I mean, I like Seth Klarman's quote because it also shows that you can't just buy whatever people are not buying. I mean, there's often a good reason why other people are not buying it. You can't just knee-jerk contrarian, right? You can't just always be whatever the crowd's not. So he says value investing at its core is the marriage of a contrarian streak and a calculator, meaning that you can't just be different than the crowd. You have to be different, and the actual thesis has to make sense. If you're investing in the horse and buggy industry, 100 years ago, you're gonna have a bad time, right? Even if it's past its prime, it looks cheap. It's a value trap. If you run the numbers, you're gonna be probably not want to go there, right? So basically, it's the combination of leaning to where people are not, but also making sure that the areas you're leading into do make fundamental sense going forward.
Yeah, definitely. That makes a lot of sense, which is a great transition into our next section, which is just talking about that concept of contrarian investing. So then I'll give you the floor here to talk about, or talk through these slides.
Sure, it sounds good. And then we actually did, the funny thing is we covered a lot of this, but basically when people are euphoric about a certain asset class or certain types of equities, a contrarian investor kind of their knee-jerk thing is like, you're not necessarily saying it's going to be a bad investment, but you're suddenly becoming more cautious, rational, and concerned about it. And maybe, for example, you have a valuation framework or a fund flow framework or something that gives you actually quantifiable cause for concern. On the other hand, when people are, afraid, there's a recession, there's some sort of bad market news, basically you're saying, okay, well, there might be opportunity here. If this whole industry sold off, for example, are there some babies that were thrown out with the bathwater? And can I go in here and see, okay, what is actually undervalued? What is actually maybe not impacted as negatively as people think? How much, when the emotion blows over, what here is actually in pretty good shape? And you kind of lean into that. Yeah, and I just have an example here. I kind of like picked a handful of different asset classes, right? So you have technology, REITs, energy, precious metals, industrials, and financials. There's very different market conditions that might lead one of these to do better than the other. For example, technology stocks tend to be highly valued. They tend to prefer, they have long runways of expected future growth, especially if they're growth oriented technology. And so they generally prefer disinflationary environments with low interest rates because then there's very low cost of capital, and you can afford to have like a big long runway of unprofitable growth or low profit margin growth ahead of you, because you can look 10, 15, years in the future and let that compound. On the other hand, if you have a more inflationary environment with higher rates and higher cost of capital, then things like energy or financials often are doing better in that environment. And suddenly those technology stocks that are trading at 20 times sales when interest rates were zero suddenly look a lot less attractive when interest rates are 4 or 5%, for example. And this is a pattern that's repeated in history. I mean, in the late 60s, for example, growth stocks were very overvalued. And then when you got the inflationary 70s, those were absolutely killed for like, like a decade. And the value stocks that were kind of cheap to begin with did pretty well. And obviously anything commodity related generally had a pretty good decade. And so basically, if you start with this kind of example pie, go to the next slide, if technology had this long stretch of disinflation and is now quite overvalued, and you start to see either macro conditions or valuations suggest otherwise, you might want to shift towards other things. Maybe you get into real estate, maybe energy, maybe financials, whatever the case may be. You get out of things that you view as overvalued and get into things that are undervalued. Now, that's obviously easier said than done. You're going against just the mindset of, it's hard to sell something that's done well to buy something that hasn't. You need an actual thesis for why that's likely to change. You don't want to just, cut your winners and double down on losers kind of systemically. You want to actually have a reason why you want to stick with them. And you have to be right about your thesis. But in general, people that are able to do this well are likely to at least do better than the average investor. And if they're good at it, can do better than the market potentially.
Yeah, and how do you handle this type of process when there's so much noise in the markets and the media is talking about what the Fed's doing every day, one way or the other, and talking about interest rates and how that impacts these sectors? How do you take out all that noise and have more of a systematic approach to this?
I think one is to be very specific about the time frames you care about. So, a trader might define their time frame as, weeks and a couple months, right? And they want to, get in and out to different things. An investor, right, might define their time frame as 5 years, right? They want an investment, you want to buy something, and they don't care what the price does, and some number of years in the future, let's call it 5, they want to sell it and have that have been like a good return. Or if it's still going strong, they can let it run until it doesn't make sense anymore, right? And so I think being very specific about your time frame lets you filter out noise that doesn't make sense while still looking for information that might either confirm or disprove your existing thesis. So basically, as the information comes in, your filter says, okay, does this matter on a multi-week basis if I'm a 5-year, value investor, or does this actually threaten the thesis of the investment itself, even over that 5-year time frame that I care about? And so I think that's one of the clearest ways to do that. And it's also one of the things where, retail investors have a lot of disadvantages compared to Wall Street investors, but one of the few advantages a retail investor has is flexibility over their time frame. So if you're a professional money manager, you're mark to market on a monthly or quarterly basis. You have a relatively short period of bad performance in a row, you're out. So you're kind of forced to chase trends. Whereas if you're managing your own money or your family's money, and basically, or you have other sort of like lockups or kind of discretionary time frame, then you have this source of arbitrage that you can do. You can make use of the fact that you can ignore a short-term time frame, for example, and focus on the longer-term time frame.
And that definitely makes sense and helps, when having your time frame set when you're watching CNBC one day or something else where the markets are up or down big, and not letting your emotions get intact, and having that plan of action seems like the best way forward, right?
Yeah.
Awesome. So yeah, I think you touched, or this is, I guess, part 3 of that process, right? Of
Yeah.
that contrarian investing.
Yeah, it just shows that maybe another cycle later, the things you got invested in are now overvalued, and then you go again towards whatever has become cheap again. So it's not about making one big decision on a pivot point. It's being able to reliably make decisions as things you didn't like, you'd like now, and things you like, you don't like anymore based on overvaluation. I mean, real estate might have been a bad investment in 2007. It might have been a good investment in 2012. It might have been a bad investment in 2021, for example. And of course, nobody can time all the bottoms and time the tops, but you can do just, zoom out approaches and say, okay, is this asset class euphoric and expensive relative to other things and relative to what its fundamentals seem like it should be? Or is this thing out of favor and yet cheap relative to what as far as I can tell, the fundamentals are going to look like over a 5-year period?
Definitely, that makes a lot of sense. And something else you highlight in your post is the S&P 500 CAPE ratio, and how you can use that as a barometer as you're looking at the markets in general. So what do you look at when you're looking at a chart like this?
So one thing I do is I look at a lot of different valuation indicators. I don't just look at one. I mean, any one could have noise in it over a multi-decade period. Something could have changed. So first of all, what I do is I look at this combined with like, say four other major equity valuation indicators. They all generally point in the same direction, but you can look for anomalies to make sure you're not, getting messed up by something. Another thing you can do is look at this compared to interest rates. You'll generally see a pretty strong correlation, but not a perfect one. There's other factors as well. And generally, when this is structurally high, especially relative to inflation adjusted interest rates, you generally should take pause in your forward return expectations. Now, if you're a passive investor, maybe it doesn't mean you make any changes, but it does mean that you change your forward estimates for what your returns are likely to be and plan your finances accordingly. Right, that's the most passive approach to use something like this. And the more active approach is saying, okay, this market might not be attractive over the next 5, 7, 10 years if it's elevated. And maybe there are other markets or other asset classes entirely that will be more interesting. On the other hand, if it's historically low or the rate of change has been just utterly disastrous to the downside, and everyone's talking about how stocks are terrible, they're never going to recover, the economy's going to fall off a cliff, we're going to be in a depression, that's when you might want to say, okay, what is this really solid company or set of companies that might be interesting? If the world doesn't end, what would I like to own? Then you can generally do pretty well over the next 5, 7, 10 years by rotating into things. And again, it's always harder to do than to say. But if you develop a pretty systematic framework to at least monitor it, and then just look for things that are interesting while keeping this kind of backdrop in mind.
Definitely. And do you have a certain rule set or even just a value that you would say, if it's under this value from a historical standpoint, that's below average or along those lines. And so this is where I might have a green light versus if it's above this value, that's when I'm kind of taking pause in terms of what time frame. Is that the type of framework you have, or where are you kind of looking at where we
I
are currently and how you assess this?
I think really hard rules like that get dangerous because you have to make sure you're not missing any variables. So a lot of people actually during, say, the late 2010s kept pointing to this, and it was over 25, for example, and they were saying, oh, it's a massive bubble. It's only been rivaled by the dot-com bubble. But 5 years later, the market's much higher, right? And it's because you also have to take into account things like interest rates. So the 2000 bubble was particularly notable because that happened despite the fact that interest rates were high, or pretty high. And so that was a truly remarkable bubble because even John Bogle, like the famous value investor founder of Vanguard, even he like made the active decision to buy some extra bonds in 2000 because he's like, this is silly. This doesn't make sense. He made like an active decision to be more defensive. So if you can look at a cash equivalents, I can get 5 or 6% by going in cash or buy equities of this multiple. It makes sense. The problem we've had in recent years is that until the past year, interest rates have been roughly zero. Money supply growth is still growing. And so basically you had stocks just keep going up and up and up. And so, if you were to exit this in, say, the late 2010s, you'd have to ask yourself, well, what do I want to buy instead? Right? What is more attractive? Is it cash at zero rates? Probably not. Is it real estate? I mean, the answer 5 years ago is probably yeah. Depends on where. And so that you kind of go down the list of what is actually more interesting. And it's kind of funny. A big theme I've had over the past several years of my research was stocks are expensive. Here's why I'm buying them anyway. And it's because, well, I mean, if we systemically compare them to other, asset classes, they were generally still reasonable. Now that started to change in, say, late 2021. So there were kind of warning signs towards the end there. But for most of that ride, if you used a very quantifiable approach, you probably would have gotten out of the market too early and underperformed. So for me, it's taking into account the high level view, but having still a qualitative filter, kind of a sanity check to say, well, what do I want to own instead?
Definitely. That makes a lot of sense. And I'm seeing some questions come in all about, your thoughts about where we are right now, which you kind of touched on there. But I think I think we can actually jump to those contrarian investments for 2023 and talk a little bit about where we are right now in the economy and the markets and how you approach contrarian investing from that standpoint. So I'll kind of set the floor with this as a precursor, which you have in your blog post as well, about short-term versus long-term projections and how forward PE kind of comes into play there. So did you want to kind of explain what you were looking at with this chart?
Sure. This goes back to making sure you manage your time frames appropriately. So if you primarily invest based on valuations, like say Warren Buffett does, or a lot of other well-known value investors, and you try to optimize for 1 year returns, you're going to have a bad time. Because 1 year market performance rarely is valuation the primary factor, right? It's more about sentiment and fund flows and liquidity conditions and kind of tactical things like that. So the chart on the left there shows basically the forward PE, price to earnings ratio, of the S&P 500 compared to returns that happened. And this is over a long-term historical period, and you can see that there's almost no correlation. Whether or not stocks are cheap or expensive relative to forward estimated earnings, it almost makes no difference if stocks do well or poorly, because again, there's so many bigger factors that can move prices over a 1 year period. The chart on the right shows forward price to earnings ratios and 5 year annualized returns. And it shows that while there's still not a perfect correlation, there's other variables to consider. There's a much stronger correlation where valuation actually does have a more notable impact. There's fewer outliers. And if you were to stretch this to like a 10-year or 15-year period, the correlation would become stronger. Basically, the longer you look out, the more important valuations and fundamentals matter. And the shorter you make the time frame, the more things like liquidity, sentiment, things like that really matter. And so when we talk about, say, what looks good in 2023, I mean, if you want to know specifically what's going to do well in a quarter or even a year, you mostly want to look at trading indicators. You want to look at liquidity flow, sentiment, things like that. Whereas what I tend to focus on, I mean, I have an overlay for that to kind of set expectations and keep track of that kind of stuff. But the bulk of my research and interest is finding things in a given period of time that are likely to do well over the next 5 years.
Got it. Yeah, and just to exactly reiterate what you said. I mean, some of these topics we're about to cover, they might not, it's not for just this 1 year outlook, which is what this chart is showing. It's for that longer term time horizon, which is always important to know, like you mentioned. So that first topic, or the first point that we wanted to cover today that you mentioned, is emerging markets. So what are your thoughts on emerging markets? What are you looking at in terms of, right here, we have the MSCI Emerging Markets Index and where it's at currently?
Yeah, so emerging markets tend to have a significant inverse correlation with the dollar index. And that's because they have a lot of dollar denominated debt. Ironically, it's mostly not owed to the United States. It's owed to Japan and countries in Europe and China, but it is denominated in dollars in many cases, sometimes euros, but mostly dollars. And so if the dollar strengthens sharply, their liabilities get harder. It's like if you bought a mortgage and you had a Swiss franc bank loan on it, and the Swiss franc soared compared to the dollar, your mortgage might exceed, you might exceed the value of your house, even if your house stayed the same in dollars. Basically, if your liability currency gets harder relative to your cash flow currency or your asset price currency, you're gonna have a bad time. And so during the late 1990s, early 2000s, they had that problem. And then really in the past several years, they've had that problem. Whereas on the other hand, if they have a weakening dollar, their liabilities are softer and they generally have a big boom. And so you saw that in the late 80s, early 90s. You saw that again in the early 2000s, that massive parabolic increase there. That's when everybody was talking about the BRICS, the BRIC nations are going to take over the world. That's where all the growth is. A lot of them reached .com level valuations. Then they had basically a decade and a half of zero returns. And there are select emerging markets out there that I think are interesting. Fundamentally, a lot of even though they've gone sideways, it looks like no progress has been done. But if you look at their earnings have increased over that period. And so what you generally had is valuation compression against earnings growth. And so the share prices go basically nowhere. And so when you look at markets like India or Brazil or other, parts of Southeast Asia, parts of Latin America, I do think that they represent interesting portfolio diversifiers. Over the past decade, it's like if you were anywhere other than American stocks, it's like you're being left behind. So far I doubt that the 2020s is going to be the same way. I think having a more globally diversified portfolio up to a point, maybe filtering out particularly problematic or concerning areas. But I do think that investors should at least consider looking globally. Now, I made this chart initially. Or actually, no, this chart you guys made, but I made a version of this chart when I published the article. Now, since then, emerging markets have become somewhat of a crowded Wall Street consensus, but I would say that's only true on a very tactical basis, right? So it might be one of those things where it gets crowded for a quarter or two, then the dollar strengthens for a quarter or two, and people forget about the trade again. Whereas I'm looking out over, say, the 2020s decade, or at least 5 years, and I say I do see a lot of value, and there are kind of pockets of interest that investors might want to look at globally.
Definitely, and looping that into your whole point of contrarian investing, I was just looking at the general periodic returns of this index versus the S&P 500, and almost on every time frame, whether it's 1 year, 5 year, 10 year, when you look back in time, it's underperforming the S&P. So how does that kind of go into your concept of contrarian investing, where it might have been underperforming, but there's a lot of outlook looking into the future?
Yeah, so I think a lot of it. So dollar index, and I think do we have a chart on this? I think one of our next slides is actually the dollar index. There we go.
Yep.
So that's the dollar index, and I mean this is basically since the 1970s, and you show that there's really only been like 3 cycles in like a 50-year-old person's like lifetime, like a whole lifetime. There's 3 cycles, and so if you just look at 5 or 10-year returns on any given period, you can get a very distorted view of what forward returns might be. Whenever this is rising, emerging markets are usually doing very poorly. Whenever it's falling, emerging markets are usually doing very, very well. If it's going sideways, emerging markets are generally not doing well, but it really depends on other factors. And so by looking at both valuations and macro factors and keeping tabs on the dollar index, I think that you can establish a kind of a framework, at least looking at the risk to reward ratio of looking out at different types of countries out there and seeing what might be interesting. So because we've been in this, the past decade's been a structurally rising dollar index period, it's been quite a heavy headwind against emerging markets. And I think it's unlikely to say continue that trend over the next 10 years. And in large part, if you combine this by looking at things like fund flows or like overweights. So there's basically, so much global capital stuffed into US markets over the past 10 years that there's really not a lot of marginal capital that has not come over that's still ready to come over. It's kind of like everybody's already on one side of the boat. And so it really doesn't take much, to if a small amount of that capital goes to somewhere else and things start to do pretty well, you can get a pretty significant period of outperformance or at least decent performance. And I think actually the hurdle's not that high. So I think, our Shiller PE ratio chart we had, one of the ways I interpret that going forward is that I think, the 2020s decade's not going to be known as a particularly strong decade for the S&P 500. Much like the next 5, 10, 15 years after 2000 were not great. I think maybe not that bad. We'll see. But basically, when I think going forward, especially from the high watermark we had at say late 2021, I think inflation adjusted S&P 500 returns are not going to be particularly attractive. And so I think it's a pretty low hurdle rate to look elsewhere and say, okay, what is actually interesting?
Definitely, that makes a lot of sense. And another, I guess, the second topic you covered, or one of the other ones you covered, was undervalued sectors for 2023. And I have this visual from our stocks page on YCharts where you can look at just different sectors and the largest 6 stocks by market cap in each sector. And this is just looking at the last year. I just thought it was pretty interesting how there's a lot of green and red everywhere. I mean, you have some sectors that have all green, like energy, but it's kind of all over the place in terms of what happened last year. And you had this chart in your blog about just the connection between value and growth and the ratio of those two indexes. So what's your take on this ratio and on this chart in particular?
So this shows basically the value to growth returns. And so when this line's rising, it means value as defined by Russell is outperforming, and when it's falling, it means growth as defined by Russell is outperforming. And you generally see these kind of structural pivots. A lot of times it comes down to what was scarce in the last decade has become so heavily invested in that now it's abundant. And a thing that was ignored for like a 5-year investment cycle is now, undersupplied, and there's a lot of opportunity there. And so, for example, in the 90s, there was no shortage of tech companies. Everybody invented a tech company. A lot of it was malinvestment. It was a very overcrowded space, very expensive. There wasn't a lot of real estate and energy and commodity development. And so when that turned, suddenly the things that were scarce, were the things that were kind of just underperforming in the 90s. And so the 2000s were a very, very good decade for commodities, banks, emerging markets. It was a different type of credit bubble. And that, of course, got overextended by the end. Everybody was over invested in housing, bricks, emerging markets, commodities. Oil reaches all-time dollar highs in I believe it was 2008. Basically, there was just tons of money all pouring into that whole complex. And after the subprime mortgage crisis, when that blew up, we had a big change in that, and that kind of set the stage for, a lot of those tech companies that were kind of left for dead or uninteresting for the 2000s were actually becoming quite interesting again. Basically, a lot of the things that were bubbles in the dot-com bubble had, worn off their high valuations, and we're actually building some of the promise that we had back in the 90s and the early 2000s about what the internet could be like. And so the 2010s decade, what was scarce was actually, at least in the beginning, was software, was growth, was technology. Everybody was all stuffed into this value emerging market commodity real estate complex. And so we had a decade of growth in the other direction. And I think what we're seeing by, the late 2010s and then early into the 2020s is that we're once again kind of like the dot-com bubble, though maybe not as excessive. We overbuilt software as a service, cloud. We placed high valuations on them, and we also have tons of them in the marketplace. Whereas we've not heavily invested in copper mines. We're not heavily invested in emerging market infrastructure. We're not heavily invested in our just in general supply chains, infrastructure, hard assets, manufacturing. We have questions around, if the manufacturing we did build over in China is still going to be accessible to us over the next 5, 10, 20 years, given geopolitical risks. And so there's actually scarcity once again in real sectors in many cases. And it doesn't mean every sector, but it means that, if you're looking for things that are maybe less crowded, I think it's still that kind of value commodity emerging market complex. Now, it doesn't mean it every year or every quarter they're going to do well, but I think if you're looking to put 5-year capital to work, I do think it's a more interesting market. It's things that have not been heavily overinvested in over the past 5 years in the way that a lot of technology has.
Definitely, that makes a lot of sense. And you also supplement that, high level thought process with the way sectors are, with some individual names as well. So I did want to cover some of those today. The first one on the list, which is in the technology sector, is CDNS. So what are your thoughts, or what are you looking at when you're looking at the price, PE ratio, and earnings yield of this stock?
Yeah, so Cadence Design, they make software that is useful for electronics and other technology designs, and it's a very good company. I used to actually use their products, but by a lot of valuation metrics, they're more expensive now than they used to be. Some of these charts are maybe not ideal for it, but basically it's an area where there's a lot of high valuation. There's a lot of interest. Everybody knows it's a good company, so everybody's kind of like already, it's already in a lot of portfolios. It's kind of seen as a company that can't really do any wrong anymore. They had a really good model where they used to, like a lot of companies, they used to sell packages of software, and now they sell a subscription. And a subscription business is more reliable, more attractive, stickier, and therefore it usually gets a higher valuation placed on it. But a lot of that's kind of already behind them, and they're still benefiting from that really good business structure. But it's in my view, companies like this are already pretty saturated in terms of what the forward opportunities are, and that there might be more interesting opportunities elsewhere.
Definitely. How about TFC?
Yeah, so this is one of the largest banks in the country. It's a result of a merger. It's not one of the big four banks, but it's in like the next set of banks. So I think it's like something like the seventh biggest bank, up there like PNC and US Bank. And in general, what you see is relatively low valuations, relatively attractive. And I cover this on a pretty fundamental level, right? So I go down into what does their balance sheet look like? How exposed are they to different types of credit? How much are they heavily invested in safe assets versus risky assets? What's happening with their net interest margin? They pay a pretty hefty dividend yield. They're getting past merger kind of extra costs associated with merger, getting rid of duplications and things like that, all the headaches that come with a merger. So going forward, they're more streamlined, and so I think almost if you ask around today and you say, okay, are you excited about banks? Do you think banks are going to do well over a 5 to 10 year period? Most people say no. Most people are like, no, I'm worried about another 2008 crisis happening again. I think, they'll say crypto is going to completely eliminate banks, whatever someone's thesis might be. No one's really excited about banks. Whereas actually a lot of my research shows that in many cases that they're the exact opposite of how they looked in 2008. So going into the 2008 crisis, banks were very underexposed to safe assets, so treasuries, cash. They were heavily exposed to subprime, and they blew up like a house of cards uh, because of a decade of conservative lending, regulations, all sorts of stuff. They're now actually historically overexposed to cash and treasuries. They're relatively underexposed to risky assets in aggregate. I mean, they're always like trouble spots in the market, but the average large or medium-sized bank is actually really in robust shape in a balance sheet perspective, and is getting a lot of interest income from the Federal Reserve due to these higher rate policies, and they're historically cheap. Maybe not all time cheap, but they're on average below their typical valuation thresholds, and so I think it's an under-owned area in general with a 5 year perspective.
Yeah, definitely. And I love the point you made about, not every sell-off is different, right? So looking at it from a '08 versus now perspective might not make as much sense as just looking at these stocks from where they are right now. What about Brookfield? And I also saw a question about this one too, so I'm glad it's on our list of covering this stock too.
Yeah, Brookfield at the current time is one that I've been bullish on for a while. It had a big sell-off in 2022. As part of a longer term structural, doing pretty well. It's also done a number of spin-offs, right? So I like some of the uh, partnerships that they have, such as their infrastructure company that pays pretty big dividends. In general, I'm relatively neutral on this one compared to say the prior two examples. So if you look at a lot of technology, at least is sold off, but the technology that's not sold off, things like Cadence, I have basically concerns around their forward return expectations on a risk-adjusted basis. Whereas banks, especially like medium-sized banks, I'm pretty bullish with a 5 year view on a risk-adjusted basis. I think they're interesting. Something like Brookfield, in my view, falls somewhere in the middle, where I think that the sell-off of 2022 presents opportunities once again. But we do have to question some of the structural things. I mean, they do have a lot of office exposure in major cities. Some of those trends are not just going to bounce back right away. I mean, we're doing this webinar remotely, for example. I mean, a lot of work has structurally changed to remote work. We're basically using office space differently than we did 3 years ago, 4 years ago, and so I do think there are more concerns with something like this compared to a really healthy bank. But I do think also that the large sell-off kind of opens up the opportunity for investors to dig in and see what might be interesting, especially because aside from their office space exposure, they do have a lot of emerging market and infrastructure exposure to some of the things that have been underinvested in for the past 5-10 years. And so I do think that if you do see major downturns, this could be a stock to pay more attention to.
Definitely. And then next is EPD.
So I've been placing energy pipelines, especially the ones that issue K1s, K1 forms, because they're a little bit of a headache during tax season, and so they don't find their way into a lot of portfolios. But for longer term investors, they're quite interesting. They're actually pretty tax advantaged. I generally place these pipelines somewhere near banks in terms of their level of attractiveness. With a 5-year perspective. And so this one is Enterprise Products Partners. They are one of the largest energy transporters in the United States. And they're heavily diversified. So it's not just oil, it's gas, it's liquefied products, things like propane, for example, that is often exported to developing countries that are actually burning biomass for things like cooking fuel. They don't have the infrastructure for natural gas. And so propane is a big upgrade for them, for example. And so it's heavily involved in propane and other things like that. And they're also a big petrochemicals transporter. And so they're heavily diversified. They are tied with a few others in the industry for having the highest credit ratings in the industry. And they avoided most of the blowups that were associated with the midstream industry, right? So a lot of them had to cut their dividends, distributions, they call them. This one actually increases distributions for 25 consecutive years by kind of being ahead of most of the trends that happened. It's got a lot of insider ownership. It's conservatively run. And we generally see that the valuations are kind of similar to how they were back in the whole 2009 period. This particular chart shows the price to cash flow per share. And so there are periods of overvaluation. There are periods of undervaluation. The 2005 period on that chart's a little bit exaggerated because they had a drop off in cash flow. And so, that they weren't really that overvalued at the time. But the period in 2014, 2015, they were quite overvalued and they did very poorly from that time, even though their fundamentals did great. I mean, they just kept chugging along in terms of fundamentals, but investors were paying too much for them. Whereas in 2009, 2010, 2011, 2012, investors were kind of underpaying for it, and they did pretty well from that time. And my contention is that ever since the big sell-off in 2020, this one, as well as a handful of others in the industry, like Energy Transfer, for example, are historically inexpensive. Many of them have either cleaned up their balance sheets, or in the case of this one, always had a good balance sheet. And so I think they represent interesting opportunities. And it's also notable that this one pays over a 7% dividend yield, which is well covered by cash flows. And like I said before, has increased for 25 consecutive years. And so with a company like this, you're unlikely to get explosive price returns. Instead, it's more about total returns. Generally, you're expecting 7% dividend yield, grow by a few percent per year on average, a little bit of price appreciation per year over a 5-year period. Some years are up, some years are down. But in a environment, if you do get that flattish S&P 500, that I'm say concerned about for the 2020s decade, then one that kind of goes flat to up and pays you a good yield along the way has a decent chance of outperforming that. And so I generally find that there is a lot of untapped value in this space.
Awesome. And that was great. Thanks, Lyn, for going through those. I know we got a few questions that came in. I wanted to cover a few that are more macro based. One question that came in from Mike says, big fan of Lyn. I'm hearing lots of questions and concerns about the unemployment numbers, establishment versus household numbers. I'd love to get your opinion and how this ties into your strategy. Does the disparity between the two raise a lot of concern in your opinion?
It does raise a moderate amount of concern. I've pointed that out in some of my reports. And so this is where it comes down to separating time frames. I have like a 5-year view. And then, for example, I publish a client report every 2 weeks for my research service. And we cover these more tactical things like liquidity, economic indicators, recession probabilities, and things like that. And so with banks, for example, they're obviously very economically sensitive. And so whenever I've been recommending banks recently, I've been saying, okay, these are, unlike 2008, they're well positioned to withstand a recession. They're already priced in at least probably a mild recession. And if they were to be impacted by a severe recession, they probably would have a bad 1 to 2 year return period. I'd be probably an aggressive buyer during that time. But that I think they're well positioned with, say, a 5+ year view, while having that caveat about monitoring these trends. Generally, what we've seen, whereas on the other hand, pipelines I view as relatively immune to especially in this environment. So in prior cycles, sometimes they blew up, but you had very industry specific problems and excesses. In this environment, I find a lot of these self-financing pipeline companies to be things that can chug along fundamentally. Their prices will fluctuate if you have a major volatility event in the market, but I think those represent somewhat more defensive holdings going forward. As for kind of the state of the economy, generally we see most things are decelerating in year-over-year terms, with the labor market being so far the stickiest. But again, we have kind of messy data, arguably. It is confirmed by things like jobless claims that are a little bit more reliable than some of those. On the other hand, when you look at some of the leading or more volatile indicators of employment, things like overtime hours or temporary help services, those have shown more downside over the past several months. And so if you imagine yourself running a business, who do you get rid of first if you're experiencing a slowdown? It's generally the temporary help services, and you start trimming overtime hours. You say, okay, you don't need you to work overtime. We don't really have too many orders right now, so we're not doing a lot of overtime. So those things kind of get trimmed first before broad employment kind of faces a problem. And so some of those are, I would say, flashing at the very least a yellow light and maybe a red light. So I think we have to monitor that closely. I would expect not great market returns with, say, a 1 to 2 year period in general, because I do think we have to factor in a reasonable probability of at least a mild recession.
Yeah, definitely. It's really important to look past just that one headline number that comes out, right? So, or a few of those. So, another question that came through was, what are your thoughts on just trend following and managed future strategies, or how are you playing some of these contrarian investments that you've talked about?
So I think those can be very good for slices in a portfolio. I mean, they can be just totally uncorrelated to everything else you're doing. So basically, if you have an edge in something, if you work in an industry or there's a certain type of investing style that resonates with you and that you have developed experience with, you can focus on that. And there might be another part of your portfolio that you want to outsource to something else. It could be trend following, it could be whatever the case may be, you can outsource that section and it kind of runs, there's a fund that manages it or something like that. And it could be whatever it's doing could be very different than the output that you're getting from your activities. And so I do think that combining different types of things like that can be useful. And the past 40 years of interest rates just going down and down and down, structural disinflation, combined with structural higher valuations, that's been very good for a 60-40 stock and bond portfolio. And people often think of that as diversified, but it's really not. It's basically one gigantic disinflation play, right? The structural trend of falling interest rates is good for both stocks and bonds. They've just gone, up and up and up. Whereas if we enter a period where interest rates are, sideways to up, even let's just call it sideways, a lot of, stocks and bonds are probably not going to provide the same types of returns they have over the past 40 years, especially the past 10 years. And we have to ask what else could maybe serve as a better hedge or a better diversifier than just stocks and bonds relative to each other. And the general answer is you want an inflation hedge in there. So you have these kind of assets that in aggregate prefer disinflation, and you can have things that prefer inflation or that are just totally uncorrelated. And for example, commodity trend following is one of those things that, commodities on average don't do very well over a multi-decade period, but when they do well, it's usually incredibly well. And it's often at times when neither stocks or bonds are doing well. And so there is a case for a long-term portfolio to have a commodity trend following component, or at the very least to have a macro outlook that at certain times understands when commodities might be setting up for one of those really good, say, 5-year periods in what is otherwise not historically a great asset class.
Definitely. All right, Lyn. Well, I think we can wrap things up. This was great. It's been awesome having such a great presenter with such a big wealth of knowledge. So thank you, Lyn, for joining. For everyone on the call, like we mentioned at the beginning, you will have a recording sent to you of this webinar, so you can tune back into it. And other than that, check out YCharts.com if you're interested in seeing some of the charts or some of the ways that Lyn's using YCharts as well. Come check us out. And with that, I think we can end things. Lyn, thank you so much for joining, and we really appreciate it.
Thank you, and thank you for putting out the product that you do. I've been using YCharts for a number of years, and I always find it helpful for identifying certain things. It's definitely one of the major tools that I use. So appreciate you having me on.
Yeah, appreciate that as well. Thanks, Lyn. Thank you, everyone. Take care.